Welcome to the Multifamily Investor Nation podcast. I'm your host, Dan Hanford. This podcast is unlike any other podcast you have been listening to. The guests on this show are true, active real estate investors closing real multifamily deals. Whether you are an active investor looking to up your game or a passive investor looking to learn more about how multifamily deals are structured, I promise you will thoroughly enjoy this podcast. So be sure to hit that subscribe button so you'll be notified of future episodes. For those of you that are interested in investing passively in these types of deals, in solid, cash-flowing multifamily deals throughout the Southeast, then visit my group, passiveinvesting.com. Fill out the investor interest form. That's passiveinvesting.com. If you've closed a multifamily deal in the past 12 months and want to be on this podcast, then send an email to Stacy@multifamilyinvestornation.com for details. Now let's get started.
Welcome to the Investor Nation podcast. I'm your host, Whitney Elkins Hutton, the Director of Investor Education here at PassiveInvesting.com. And I'm so excited to be joined today with Dan Krueger and Julie Holly. Dan and Julie, welcome to the podcast.
Hello.
Great to be here.
Yeah.
Awesome. Well, hey guys, before we dive into your deal here that we're going to cover, Olympus portfolio, 123 units in Minneapolis, Minnesota. Tell us a little bit about yourself, how you got into multifamily and where you're at today.
I'll go first, try to keep it brief. Quick backstory on me. I started out following the kind of typical path that most people do. I went to college with the intent of spending my entire life in the corporate world and spent about 5 years in corporate finance before I realized that that wasn't really the right fit for me. And started a side hustle unrelated to real estate, but realized that the entrepreneurial thing was where I needed to be focusing my energy. Shortly thereafter, found myself going down the real estate rabbit hole and got really hyper-focused on the multifamily, the larger multifamily, as opposed to smaller properties. And that was just addictive. As I started learning more and more, it just made so much sense. So it was 2018 when I got my first 6 units, no investors yet at this point, but stuck to the usual buy it, fix it up, refi it, and keep on holding routine, and started accumulating small properties in the area between 6 and 15 units. And that eventually scaled into a syndication model where we started raising capital from first friends and family and investors. And I joined teams with my partner, Anthony Vicina. We started operating under the brand Invictus Capital. And now we run a portfolio of about 500 units up here in Minneapolis, Minnesota.
Awesome. Julie?
Yeah. Well, I took a different route. I became a teacher at 22, and my husband and I had this vision of just building this single family portfolio to retire on down the road. Well, then we had kids and we did have some property, and it was like, actually, after baby number 2 came along, I'm like, it's all been great. I've been managing. It's been successful. I've done this from 1,000+ miles away. So I know I don't have to live right next door to whatever we own, but I felt so vulnerable. I'm like, what if? And I don't recommend allowing what if to play out in your mind, but it did serve us to the point of, okay, let's get out of this because we have one roof, one door, one unit, one resident. Sure, we've got the reserves, but one big thing happens and all of your profit for the year is gone. One resident leaves and maybe you can't fill that vacancy for whatever reason for a few months. It just felt really, really vulnerable. And I think sometimes maybe other moms who are listening might feel that same, especially after you're raising your flock and you're like, I don't like this. I want safe and secure. So we exited out of that path, and I'm 3rd generation in real estate, first in the investing side of it. And so it's like, wait a second, I want to invest in something. And this money was sitting in the bank account and it was just making me nauseous. And so I just went to my husband, like, listen, we have to put this money to work. And we've got a great relationship. He's like, that's awesome. I know you're driven. Like, why don't you give me some ideas? Which is also great because, hey, you go do the work and bring it back to me. And I did. I ingested tons of podcasts, researched a lot of different investment strategies within the real estate realm, because we knew we wanted to stay within real estate. And from there, I discovered apartment syndication. And to me, it was literally like this whole, the clouds are parting and like everything is breaking through, because it was a matter of, wow, every skill and ability that I've developed and cultivated throughout my lifetime is utilized within the syndication model. So my background in education, well, I educate investors. My love of people and wanting to serve and support people, well, that's a huge component. My love of real estate, my knowledge of real estate. So all the parts of my background, it was a perfect harmony and it was a great opportunity. I jumped into a program. I started going to conferences. I joined a program, spent a lot of money on another college education, basically, just because I felt if I'm ever going to receive, and my plan was I want to serve investors. Specifically, that is my target and my goal in life and the hat that I want to wear. And within that, it was, well, if I am going to ask people to entrust their money into my care as an investment, I need to be fully vetted myself. So put that money in, put in the time as a limited partner, and really did a slow process in the growth journey of growing out a portfolio. Now we're at roughly 550 units on the GP side and about 300 units on the LP side.
Awesome. Well, congratulations to you both for this journey in life, journey that so many people I'm sure here can resonate with, either whatever stage they're starting out or they're trying to get into their next deal. So let's talk about that.
Are you a passive investor looking to diversify your portfolio? The team at PassiveInvesting.com is thrilled to introduce the investment opportunity of our real estate debt fund. This debt fund places first position loans on rehab projects sourced by our private lending company called Rehab Wallet. Since we started this debt fund in June of 2020, we have funded over $260 million in loans to borrowers across the United States. As a limited partner investing alongside PassiveInvesting.com, you can be part of the success of Rehab Wallet. With a minimum investment of $25,000, you can seize the opportunity to earn a preferred return of 6 to 8% with a 90-day liquidity option to call your capital back. Our real estate fund has been a great investment for our investors to have a short-term or rainy day cash reserve with a high yield return option. Don't miss out on this chance to enhance your portfolio and your financial future. Visit PassiveInvesting.com to discover more about this real estate debt fund and start your journey towards a prosperous investment today. That's PassiveInvesting.com.
We've got the Olympus portfolio, 123 units in Minneapolis, Minnesota.
You could say the Twin Cities too.
Right.
The Twin Cities. Rolls off the tongue.
Cities, right. Probably an easier path for me there. All right. So let's talk about this. When did you guys close this deal?
So this one's an interesting one because this was actually a series of closings that we executed within a fund structure. So the first closing for the first property was at the end of June 2022. And then the very last one we closed mid-September of 2022.
All right. Let's dive into that. I like backing up the timeline a little bit. How did you find the deal?
Yes, this one's fun because it's such a great case study of how important relationships are in this business and like really any business, but especially in real estate. It's definitely a relationship-driven business. And Invictus Capital has been locally focused and operating in the Twin Cities, which for those of you who aren't aware, that's Minneapolis and St. Paul. That's what we mean when we say Twin Cities. But we've been hyper-focused in this market compared to a lot of other groups who are investing all over the place. That's great. You get exposure to other markets, but it's really tough to build the kinds of relationships you can build when you're operating in your own backyard for many years. And so the seller on this deal, we had purchased 5 buildings from starting in 2021. And we started to kind of pick up on the fact that he was probably near the end of his career, or at least closer to the end than the beginning. And it was on the last building that we purchased from him before this portfolio, which was in January of 2022, that it became clear that he was actually going to be selling off the rest of his portfolio and doing 1031 exchanges into triple net lease properties because he was ready to just kind of kick back, get a decent yield, and try to do something a little bit easier. Very management intensive business. So we had built up some really goodwill with this individual. We'd helped him close on his timeline, get him the price he wanted multiple times. And so he was confident that we'd be able to execute on his timeline because he had probably 7 or 8 different 1031s he had to try to coordinate throughout the years. And so instead of going to market with this and trying to broker it out and get the highest price, he wanted to go with a group that he was sure was going to close. And since we were also buying his management company along with the portfolio, he had a really great team that he had developed for over a decade, and they're like family to him. So he wanted to make sure that they were taken care of. And it just so happened that we're in a tight labor market and it's really tough to find talented people. And so it was a win-win for us. We're like, yes, we want the people. We can adhere to your timeline. And so we ended up getting this good margin below the average going rate for these types of properties, which was great.
That's awesome. And it is definitely something that we haven't really covered here very much on the podcast, or at least recently, is we talk about quite often that if you are the buyer, building that relationship with the broker, and then hopefully they remember you when they get their next pocket listing or whatever. In this case, building up that goodwill with the seller. So when they decide that they want to exit out of the portfolio, you already have that relationship built and they come to you first. Quick question here. At any point in time, did he try to or look at bringing in another group just to kind of price it out a little bit? Or were you guys just the only ones?
I mean, this guy has effectively been my mentor for, definitely throughout this entire transaction, but he was already kind of starting to play that role before this. And he just really liked the fact that some young local guys were coming in and picking up where he and his cohorts were leaving off, because he came from a generation that started acquiring properties in the 90s. And there's only like 5 or 6 of those guys that own pretty much everything. And they kind of like to see a couple young local guys come in and do it, as opposed to some other group that he doesn't really have a relationship with. So he liked us, basically. So he didn't feel the need to try to bid it out. He really wanted to see us succeed. And like I said, he really wanted to see his team well taken care of. So he wanted to try to keep the portfolio together, one buyer, and really make sure that his employees were in good hands when he left.
I was thinking, if you don't mind, like interjecting here on this also, is that a lot of times people hear this narrative and they think, oh, that doesn't actually really happen. And so if you're listening and you're one of those people that's maybe a little skeptical of, do owners actually really do this? It's like, this is proof of concept. And I was on the phone with another investor yesterday who purchased something in their chosen market directly from the seller with a 4% seller financing on top of that. So it's like, yes. And it's fixed. And so I just want to encourage people, because of the type of times that we're living in the investment cycle, is that these things are real. These sellers are really out there, and you want to take the time to develop those relationships.
Yeah, we talk about that concept all the time on podcasts and just in the office. It's one of our core values, which is we lead with value. What that basically means is our goal as a company and as individuals is just basically just to go around and try to help everybody around us as much as possible. And if you do that for long enough and consistently enough, at some point in the future, something's probably going to come back to you. So it's definitely the long game. Usually it's going to take many years before you've got a relationship where somebody's willing to really bend over backwards like he did to try to help us succeed. But if you can do that and try not to be transactional and try to play the long game and build up some good karma with people, it's never going to go bad for you. Like, there's no downside.
You never know who they know too, right?
Exactly.
With that,
worst case scenario, you help somebody out, you never get anything back. It's like, well, still feel pretty good if you able to help somebody out. So.
Well, I have a couple questions here before we kind of move on to the due diligence period. One, it sounds like there's multiple properties here. What made you decide, and with his timeline of doing multiple 1031s, and obviously these closings were going to be spaced out, what was the decision? What was the impetus for the decision to group these together as a portfolio as opposed to just close them each individually and raise capital individually?
Yeah, a few reasons. It's a good question because not all the properties that we got were actually in the fund. So we actually got 212 units from him total, but it's almost exactly down the middle, where half was raised in a fund structure and then the other half were a couple smaller deals that they weren't really syndications, but we have a handful of investors that we've worked with over the years that periodically are going to have 1031 funds that need a home. And we had a few of those guys who needed to allocate some capital. And so if you've got a 1031 investor, it's usually a lot easier to, instead of trying to syndicate it, to just do a small joint venture with that other group. And that combined with the fact that these properties that were grouped in the fund, very close proximity to each other, had a similar style, a similar vintage, because there was one suburban property that was built in 2008, very different. And then there was another property that was in a different city in St. Paul. And there was another one that was really beautiful, but it would have been a C-class building, but it had been decked out to the nines. About $90,000 per door was put into it. So it was effectively a new build. And so these other buildings, while they were great, they didn't quite fit the same story as these. And so it made sense to group these together in a fund and then do the others individually because of those other nuances with other 1031 investors and just not really fitting the same narrative that applied to these properties.
Understood. All right. So let's move on to the due diligence timeframe, because this is all happening June, July, August, right? Like right during the crazy ramp up with the interest rate.
Yeah.
So I want to make sure we leave plenty of time for that story. So let's talk about due diligence. Where did you guys close at price-wise? And how did you structure your agreement?
Yeah. So because of the relationship with this, if I can remember correctly from the PA, we did allow ourselves a very large window for due diligence. When it came down to it, it made sense to just go through the physical inspection with our inspector all at once, right at the front end. So instead of doing what we would typically do when we just close an asset, we would do the due diligence and then wait and close a month later or something like that. We were doing the DD, at least the physical due diligence, in some cases months before we were going to close in some of these properties. So it was about 3 solid days of just walking every single unit. And this time, because we had a really robust team, I didn't have to do every single unit, but our operations director did, the inspector did, and because the sellers just really wants to see everything go well, he walked every single unit along with the inspector and everybody else. So that all went quite well because this individual is one that really takes pride in his assets and really likes dumping money into them. He came from a construction background. He's just one of those guys that loves renovating and loves doing it really well and keeping his properties in pristine condition. So there weren't any surprises that came up during due diligence. And by and large, we came in under our initial pro forma budget for capital improvements and things like that by a pretty significant degree. So we went in expecting on the first pass of underwriting to be spending X, and turns out that these things are in great shape and probably weren't going to end up spending as much as we had originally underwritten for.
And so what did you guys put him under contract for?
So the purchase price for this group of buildings was $17.14 million, which breaks down to about $139,000 per door. And then the median price per door for similar assets in the area is about $158,000 per door. And these, and I'm biased, on the nicer end of that spectrum in the area for this type of property. Because like I said, this guy really takes pride in making his properties beautiful. He's not the type to cut corners and just try to do the minimum to get the maximum rent. He really wants to create and maintain beautiful properties. So we got a good deal on it.
That's awesome. And so what was your business plan in picking up not just the entire portfolio, but specifically these vintage properties? Like, what was your business plan? What caught your eye about these?
Yeah. So, the quality of the assets, just because we had experience with buying properties from this individual prior. And so we've acquired and operated assets we bought from him and knew that these assets that we bought from him were coming over with, you could tell there was a lot more care put into them. Stuff wasn't skipped. You didn't find duct tape solutions to things. Like sometimes you'll buy a property from somebody and you can see some pretty suspect repair jobs that were done. And that's not the case with this guy's stuff. So the business plan on this was actually not so much that the properties had deferred maintenance or needed significant upgrades. It's the fact that this guy was nearing the end of his career, at least in the multifamily space, for several years because he was managing a house and very involved with the operations. He was trying to minimize how much work he had to do on the management side. And so he did this by keeping his rents on the lower end of what the market rates were and really trying to maximize occupancy, reduce turnover. And so the value add opportunity was basically unplugging the about to retire owner and plugging in a younger group that was actually trying to grow and expand. And so it's really all about getting those rents up to market rents slowly while maintaining high occupancy. But it's not going to take a ton of capital to do it. It's just a matter of more aggressively leasing and being fine with the workload of a little bit higher turnover. So they're below market rent, but not because we have to dump 10 grand.
So, okay, we talked a little bit about physical due diligence. You said there's no surprises. If anything, your CapEx budget came in a little under or lower it. What about the financial due diligence? Any surprises there?
No, I know that makes for a boring story on a podcast, but typically that, whether it be the physical side or the financial side, usually you're kind of expecting to find some skeletons in the closets when you're transacting with people that you don't have experience with. But after going through multiple transactions with the seller before, we already knew that we were dealing with somebody who's going to be very transparent and not try to hide any of the issues. So anything that did need to be dealt with, we were aware of well ahead of time and was factored into the price point that we agreed on. On the financial side, things were in really good shape. He had very good records. He had very high leasing standards. So we didn't have to deal with the usual kinds of issues you find there with unqualified tenants or people that are technically in a unit, but not actually paying. So physical occupancy might be high, but economic occupancy is not looking too great. So that all penciled out nicely. And on top of that, he wasn't really even charging us for the fact we were getting his management company. So we got some vehicles with the purchase and a plow. So we technically paid for those, even though we were paying under Blue Book for the value of the vehicles, but he wasn't charging us for the people. He wasn't charging us for the office equipment or supplies or tools or any of the materials. And so there's arguably a couple $100,000 of value there that we weren't paying for. And on the way out the door, he gave all of his employees all the employees, but higher level employees, 6-figure incentive bonuses to stay on with us. So this wasn't something where we were I don't think there was really a chance that there was anything being hidden in the financial due diligence, right? Leases, everything was top notch. So why we like to try to transact with the same people over and over again. So you don't have to go into these transactions kind of adversarially and try to see, okay, what's this guy lying about? What's he hiding? Like, he's on our board of directors now. And so he's still very much involved in helping us. We just had our first fire at another property, not in this portfolio. He's been a godsend on that because I've never had a building fire before, and he's making it as easy as it could be. So it's a really great relationship. I can't say enough about it.
That's amazing. Well,
Yeah.
I want to move on to the financial piece. And since Julie is on here, you guys obviously are partners in this deal. So talk to us about the general partnership. How did you guys structure this deal and who took on what roles?
Well, I love
You want to give the rundown, Julie?
I'll give a little bit of the rundown and then I'll let you jump in. And actually, there are some pieces that come with my role that I'm like, oh, that actually would be kind of interesting. Some of the things that I fielded with this deal that are from my investors. So as we said at the very beginning, we established like my whole heart and soul, my company, Three Keys Investments, is all about bringing investors into high quality opportunities. And the relationship with Anthony and Dan Invictus Capital goes back, and it's a couple of years, and it's just been a great relationship. So that's where that starts. And now I lost track of the question. Rabbit trail.
Yeah. So the actual general partnership. So I guess this kind of goes to like the capital stack. How did you guys form the capital stack? You guys raised for the money or raised for a portion of the deal. So how did you guys form the general partnership? How did you split the general partnership, and kind of who took what roles? And really the reasoning behind this question is, and I'm sure you guys get it too, when you talk to investors are kind of like, well, there's other people that are raising on this deal, or I've seen this deal. Like, tell me about the history and what the relationship is there. Who's doing what? I guess just can you dive into that a little bit?
I'll add just a little more to what I was saying, and I appreciate that, Whitney. And that is that one of the things that my investors know is that my company only participates in deals with people that we have established, vetted relationships with, minimum of a year. We want to know them. It was interesting. I was flying back from another asset, and Anthony and I were on the phone. We weren't even talking about partnering up. We weren't even talking about deals. We were just talking about life and what are we looking for with our businesses? What does that look like? And we just were talking about what's going on in the industry. We're just having one of those fun conversations where we like nerding out on, so many of us, we just love nerding out. You're listening to this podcast for a reason. You like to nerd out on real estate. And so we're having this really fantastic conversation. And that really opened the floodgate because he understood further what my company, and he was hearing my pain point, quite frankly. I'm like, man, I have a 506C offering and I have a bunch of sophisticated investors that really need to be served in a powerful way. And that really opened up the gateway to this particular opportunity, which they've been like, Invictus Capital is on my short list of like, I had 3 friends, 3 companies that I'm like, if I could ever partner with them, that would be, now I've officially partnered into all 3 of those with all 3 of those friends. I think the interesting part about that is when we're able to voice, when we understand what our investor needs are, then we're able to articulate. And when we have the relationships, which that's really a focal point of this entire conversation, the golden thread is the relationships with the people operating in our local markets, the relationships with our investors, the relationships along the way are what paved the path forward. So knowing what my investors needed, having relationships with people in the industry that are trusted relationships, just allowed Anthony to go back to Dan and have a conversation. And one of the shared values is a small general partnership, not a big circus of people on the GP side of things. And that's one of the elements that I really valued about this opportunity to partner with you guys.
Awesome. So let's talk about the specifics though. Like, how did you guys structure the general partnership and who took on what roles?
Are you a serious real estate investor looking to break into the multifamily space? Or are you an experienced multifamily investor looking to level up your game by meeting new passive investors and creating new partnerships? Have you heard of the MFI Incon happening in Charlotte, North Carolina, June 12th through the 14th? The Multifamily Investor Nation Convention is a place to learn from over 60 plus high-level speakers and also to network with over 700 serious multifamily investors. If that's not enough for you, A-Rod. Yes, Alex Rodriguez, 12-time Major League Baseball All-Star with over $700 million of commercial real estate, including apartments, will be live and in person speaking at this event. Also speaking is the one and only Dr. Robert Cialdini, the godfather of influence and the award-winning author of the book Influence, one of my all-time favorite business books. finally, we will have the CEO of Taco Bell, Mark King, joining us on stage to talk about leadership. Be sure to secure your tickets to this live in-person event as the tickets are going fast. Go to mfincon.com to find out more details. There are also sponsorship opportunities available for those of you who would like to have a booth at this event. For the details for this event and to purchase tickets, visit mfincon.com. You can use promo code MFINPodcast, all one word, MFINPodcast, to get $200 off tickets, and that's mfincon.com. Look forward to seeing you there.
Yeah, so in this one, it's probably a little bit more backstory here. Like I mentioned earlier, we acquired 212 units total from the seller in the purchase agreement. And so, like I said, half of the deal was in this fund. And then about the other half, it's actually amazing in retrospect how dead center down the middle is. But the other half was done in the joint ventures with a few 1031 partners. And so that's a bigger raise for us. It was about 12 million, just under 13 million total that we would raise for all the deals that we had under contract with this individual. That's a big one for us. And it's big on the amount of debt that we needed, and it's big on the amount of capital that we need to raise in a shorter period of time. And so that's kind of how the general partnership group on this one came to be. Because like Julie mentioned, at least on the Invictus side, we like to try to keep a pretty lean crew on the GP side, which I've seen some groups where the list of general partners could be 10 or 15 people. And it's kind of like, okay, what is everybody really doing here? We take the opposite approach. We try to keep it as lean as possible just because you don't want too many cooks in the kitchen, really. If you want to have other cooks in there, you want to make sure that you're morally and philosophically aligned. And just like Julie, we've got a very, very short list of people that we would actually partner with on stuff like this. So for the reason that we would need to take out a significant amount of debt for this, we did have one individual who acted as a key principal. We've actually never done that before, but we needed to get about, I think it was about $26 or $27 million worth of debt, which was a little bit of a stretch given our current balance sheets and how much we had grown the prior year. And so to make the bank comfortable, we brought in a general partner who got 5% of the GP ownership for basically just being the balance sheet partner across the board for everything in the fund and everything that was also done outside the fund. And then it was myself, Anthony Vicino, and another local partner that we've worked with on several deals in the past named Joe. He was a co-GP on a lot of the deals we did in 2021 as well. And then Julie, obviously, would be the other one that was involved. And so, like we kind of mentioned before, Julie is helping out with the capital side. She had investors that wanted a good investment to make. We were working on a big, heavy lift with respect to the capital raise and the timeline that we really wanted to hit because we wanted to keep our relationship with the sellers as good as possible and not take too long. And then obviously the asset management as well. I kind of mentioned this. I don't think we were on the air yet. Julie's going to be helping with disseminating the asset management role to her investors. So we're going to be doing regular check-in calls with her. So it's almost as if she's boots on the ground with us. So she'll be up to date and be able to field questions and take on the communication for her investors and make sure they're kept in the loop as well as possible. And then capital raise for Julie, key principal individual. That's really all he's doing. And then the other local partner I mentioned, helping out with the capital raise. And then Invictus is doing most of the things as far as guaranteeing the loan, operating the assets, taking the full asset management role. Julie is helping with that. And yeah, all the other things. We have the property management side of things. So operations from boots on the ground all the way up to asset management. So hopefully it was a somewhat clear answer to your question.
Yeah. And I think it just helps pull back the curtain for investors to understand that there's a lot that goes into relationship-wise, execution-wise, into taking down one of these deals. I mean, to borrow a phrase, in raising kids, it takes a village, right? Same thing with real estate. It takes a village to get one of these things across the finish line.
Yeah, it's pretty rare one person can check all those boxes unless they've been in the business for 10 plus years. If you're less than a decade in, you're probably not going to be able to check all those boxes unless you're doing deals that are on the smaller end of what you could be doing.
And I don't know that that's always the best either to do it solo. I mean, I want somebody else's eyes on things. And I completely believe in living and dwelling in the zone of genius and playing to your strengths. And so anytime that we just think we can do it alone, we're probably going to miss something in that movie Meet Joe Black when Brad Pitt gets hit by the bus. Or there are a lot of movies like that recently where people, I'm like, I just don't want to get sideswiped, especially when you're bringing in investor capital. Like that's not the time.
Couldn't agree more.
Well, let's talk about the investor capital side. So how much debt did you guys secure on this property? How much did you raise from investors?
Yeah, so we ended up with about 73% leverage on this. So about $12,517,500 to be exact. And the blended rate, so like we mentioned before, I'll get into the debt stuff later. So yeah, we put about 73% leverage on, raised $6.5 million from investors. And then this was structured in a 75-25 split with investors and had a 7% pref. And for this deal, this is the first time we actually experimented with preferred shares and common shares. So we had two share classes. Only differentiating factor was that the investors who put in $500,000 or more would get a slightly different waterfall. So common investors, anything under $500,000, you would have a 7% pref, 75-25 split up until you hit 15%. And then after 15%, the split goes to 50-50 instead of 75-25. The preferred class, only difference is that nothing changes after 15%. So that 75-25 is static no matter how good the deal does.
Interesting. Okay. So let's talk about the debt. This is June, July, August. Something happened last year during June, July.
I don't think anything happened. It was pretty boring, pretty quiet.
Pretty boring, pretty stagnant.
Yeah.
Okay.
That feds didn't do anything.
Jerome Powell took a vacation. We never heard from him. Okay, so let's talk about the debt piece. How did you guys source the debt for this deal? And I'm pretty interested in understanding, since you had multiple transactions going on in just a few of these groups in a portfolio, how did you make all these puzzle pieces come together?
I don't know. So yeah.
That's an honest answer. There you go.
Yeah, no, I'll walk you through it. So first off, I don't know when this is actually airing, but I want to say we might be on the cusp of the 1-year anniversary of the very first rate hike. And I think we just, as of yesterday, I think we've had 9 last year, 9 hikes. So we went from historically low to historically high in the course of a year. And we were trying to close this deal right in the middle of the launch where things started. So very interesting time. So we found the lender for this bank when we closed the last property we bought from this guy before we started on this transaction. So like I mentioned, we bought 5 properties from him. The most recent before we got this big thing under contract was in January of 2022. We were working with a local regional bank. I think we found through a mortgage broker, actually. Yeah, we found through a mortgage broker. And they had a very big appetite for local multifamily. They're very great to work with. I want to say the rate we got on that deal was like just over 3%. In January, 30-year term, 30-year amortization, 5-year term fixed, and 3 years of IO. So we're getting pretty good terms from a local regional bank, which is our MO. We'll execute our operation, and by year 2 or year 3, depending on the asset, that's where we'll go and refi and put long-term agency debt on, usually with Freddie. And so it was the same MO with this portfolio as well. Plan was to get in there, execute our business plan, get those rents up, and by year 3, be transitioning over to agency debt. So we went with the same bank. And they were really great to work with. And they even let us lag the market a little bit as things were taking off. Because like I mentioned, the first closing was June 30th. And so we already had a few rate hikes in there. And so we ended up actually getting a blended rate between June and the September closing of about, where did I put that? 5.1%. But the first things we were closing were either high 3s or low 4s. But things just kind of took off like a rocket. But they did let us lag the market a bit. They were very accommodating because this had been on their desk since about May is when they started underwriting it. So they gave us a little leeway there. But fast forward to the end of the year, November or December, for those same deals, we would have been getting 6.5% easily. So ending up with a 5% blended interest rate across the portfolio is actually not too shabby.
Very cool. Were there any prepayment penalties, lockout periods, or anything with this debt?
These all have 3-2-1. So by the time we get to that 3rd year where we'd be planning on doing our refi, it's not too outrageous. And then if we waited longer, just past that 3rd year, then there would be no prepay.
So tell me, do you have a crystal ball? Like 3 years from now, when we have to reposition the assets, where do you foresee things standing?
I'm actually going to jump in on this real fast. Yes. One of the things that I appreciated about how this deal is structured, but hasn't been touched on, as I worked with investors on presenting this opportunity, is that, yes, we have a 5-year exit plan, but there is also, and this is the first time I'd ever seen this put together in this way, was like, hey, we have a stretch goal. And so as we talk about the crystal ball, it's really important, I think, that as people move forward, demonstrating to your investors how you are protecting them and how you're mitigating the risk, and that you have a viable plan in place that is going to continue to deliver the returns that they're looking for and that you are proposing, even if XYZ happens, because we don't know. So many unexpected things have happened over the last 3 years. And so having that stretch goal contingency plan, we call it stretch goal. Some people might call it something else. I think that is really powerful to say, again, here's a 5-year plan. We're going to exit, dispose altogether, or here's our stretch goal. We're going to refi this and we're going to hang on to this for 7 years instead.
Well said. Thank you. So one thing that I didn't ask here that I usually touch on whenever I talk about the capital raise, what was your fee structure on this deal?
So we did, 2% acquisition fee, 1% loan guarantor fee. So that's roundabout, it's kind of 3% for those. And then the asset management fee, and those were the front end fees, just one time up front. And then the asset management fee throughout the life of the deal is going to be 3% on gross revenue. And then we have the disposition fee of 2% and a refinance fee of 1%, assuming we actually do that.
Okay, awesome. In wrapping up, what did you think was going to be easy that actually ended up being challenging? And then vice versa, what ended up being challenging about this deal that you actually thought was going to be a little bit easier?
So the first thing that comes to mind for me, at least, is the capital raise. Even though it was a heavy lift for us, I did not foresee the historic change in interest rates coming. I don't think anybody did, because up until it happened, the Fed just kept saying we're not even thinking about raising rates, and all of a sudden they're jacking them up like crazy. So that happening, combined with the general kind of public market equity sell-off throughout 2022, combined with crypto blowups, around about middle of the year, it became clear that investors just across the board were feeling horror. A lot of people watched their portfolios, not necessarily real estate, but equities, or if they were in crypto. I think we had 2 investors that were negatively impacted by some of the crypto stuff that blew up last year. But generally speaking, people were watching their portfolios tick down all year. And so by the time we got into like July and August, people were scared. You could tell that people were just really hesitant to allocate capital to anything. And then we kind of start to see the public markets rebound a little bit. By the time we hit that September, October range, everyone's chomping at the bit and people aren't able to get into the deal because it's full. But it was really interesting to watch that dynamic play out. Because we came in thinking, this would be it's a big lift, but it'll be so easy because these assets are so beautiful. There's so much upside. There's not that much downside. It's like all this stuff was great. And then we see the public markets do their thing. And all of a sudden everybody's like, whoa, do we have any money left or do we lose it on the stock? So that was unforeseen, difficult, but we got it done.
I would actually double down on that also, is that knowing that I had sophisticated investor base that had expressed an appetite for getting involved in it, the next offering, and then having all of this discord taking place in the financial markets, that really lent itself to a lot of apprehensions, which required a higher level of education, a little more hand-holding, more nurturing than, hey, if we would have done that in the late winter, early spring, it would have been a slam dunk, like boom, like everybody's in. But people were hesitant with that. I thought that was really interesting. Also feeling some of people are just scared. They're really scared. And so that led to, honestly, a whole lot of investor education that I wasn't intending on putting out, but just really educating investors as to why we invest in every market cycle, why the interest rate doesn't determine whether or not we're investing or not, but we're looking at the numbers in the deal. We're looking at this deal, this structure. If the interest rate is 10% and this is still a viable deal that's going to deliver the returns that we're looking for, it's still a deal to invest in, right? So it's like just learning to say, okay, we're going to build a portfolio in every market cycle because we only present offerings that are going to deliver those returns that you are looking for. So I think that because we've been on such a beautiful, we've been in this beautiful market for so long, despite 2020 and all the calamity that brought, everyone thought that would just bring the market down, and it didn't. That was an amazing investing opportunity for everyone, which was a surprise and everything. So just having to really educate people so that their mindset is starting to shift into, okay, it's fine. You've been investing for the last 5 years. You've been investing during the golden age, basically, right? One of these beautiful parts of the cycle. And you can still invest the next coming part of the cycle, and you can be abundantly successful.
Thank you for that. And it's definitely a conversation that I have with our investors as well. So Dan, Julie, thank you so much for being on today and sharing your knowledge and expertise. If people want to find out more about you and reach out to you, how can they do so?
When this goes live, my new website will be live. So just type in a sentence in your URL, type in, I am a conscious investor, and you can access all parts of my company, The Conscious Investor, 3 Keys Investments, Conscious Investor, meaning the podcast, the investments, the performance coaching, the book club. There's just a lot going on that we offer to really serve and support investors at every level and just humans in general. And so just go to IamAConsciousInvestor.com.
Awesome.
Yeah. And for us, definitely recommend people check out our podcast. It can be found anywhere podcasts are found. Multifamily Investing Made Simple. So just plug that in wherever, Audible, iTunes. Spotify. You can also check out Passive Investing Made Simple. Quick little plug there. On Amazon, you can also get it Audible as well. Basically just the 101 on how to be a limited partner in syndications. And then website is invictusmultifamily.com. And if you want to find me personally, you can just plug in Dan Krueger to LinkedIn, Instagram, Facebook, all those things.
Well, Dan and Julie, thank you so much for being on today. This has been such a pleasure. Yes. We look forward to hearing about your future deals.
Awesome. Thanks so much, Whitney.
Thank you.
Thank you for listening to the Multifamily Investor Nation podcast. I trust you enjoyed this episode. Take a moment right now to leave us a review and let us know what you learned. Also, don't forget to visit passiveinvesting.com and fill out the investor interest form to invest alongside me in excellent multifamily assets located across the Southeast. That's passiveinvesting.com. Thanks again for listening, and we'll see you on the next episode.